Hi everyone, welcome back to Books and Backbone. My name is Donna Harris. I'm the owner of Bookkeeping Made Simple and your host. And actually today I want to talk about something that's been in the news for the past year and that most small business owners I speak with still don't fully understand, which is the One Big Beautiful Bill Act. Maybe you've heard the name, maybe you've seen the headline, maybe your accountant mentioned it. Maybe you've been meaning to look into it and haven't gotten around to it. Today I'm going to tell you what's actually in it. Specifically, what matters to you as a small business owner, and in plain English, without political commentary, without tax code references, and hopefully without making your eyes glaze over. Because there are decisions you should be making right now in 2026 because of what this legislation does. And if you don't know what these decisions are, you're leaving money on the table. So let's get into it. First, the context. The One Big Beautiful Bill Act, or the OBBA, was signed into law on July 4th, 2025. It was the largest piece of tax legislation since the 2017 Tax Cuts and Jobs Act, and its primary purpose was to make permanent many of the provisions from that 2017 law that were set to expire. Here's why it matters. Without this legislation, July 1st, 2026 would have looked very different for small business owners. The top individual income tax rate would have reverted to 39.6%. The qualified business income deduction, the 20% deduction that most pass-through business owners depend on, would have disappeared entirely. Bonus depreciation would have continued its phase down towards zero. That was the cliff that was coming. The OBBA prevented it, and it didn't just prevent it. It made several of these provisions permanent and in some cases expanded them. Here's what that means for you. The most important thing in this bill for most of my listeners is the qualified business income deduction. If you run a small business, a pass-through business, an S Corp, LLC, sole proprietorship, a partnership, basically anything but a C Corp, the QBI deduction allows you to deduct up to 20% of your qualified business income from your taxable income. It was one of the most significant tax benefits ever created for small business owners, and it was set to expire at the end of 2025. It is now permanent. Let me put this into dollar terms so it lands. If your business generates $200,000 in qualified business income and you're in the 37% tax bracket, the QBI deduction reduces your taxable income by $40,000, which saves you nearly $15,000 in tax in a single year. That deduction is now permanent. It's not going away. You can plan around it indefinitely. There are income limitations and phase-outs that apply, particularly for certain service businesses, including law, consulting, and financial services. Not so much accountants as wealth management, but certain service businesses. And the thresholds have been expanded and made more taxpayer friendly under the new law. If you're not sure whether your business qualifies for the full deduction or where you fall in the phase-out range, that's a conversation to have with your tax preparer before the end of the year. What I can tell you is this. If you have an S Corp or pass-through entity, and again, if you don't have a C Corp, you have a pass-through entity, and you are not calculating and claiming your QBI deduction, you are overpaying on your taxes. And the OBBA makes that deduction available to you permanently. The second major provision that matters for small business is bonus depreciation. Here's the history. Under the 2017 TCJA, the Tax Cuts and Jobs Act, businesses could immediately expense 100% of the cost of qualifying equipment, vehicles, software, and other assets in the year they were purchased. No depreciating it over 5 or 7 years. You could take the full deduction in year one. The provision began phasing out in 2023. By 2026, under the old law, bonus depreciation would have been 20%, and by 27 it would have been zero. The OBBA permanently restores a 100% bonus depreciation for qualified property placed in service after January 19th, 2025, which means in practice, If you buy a piece of equipment, a vehicle, or qualifying software for your business in 2026, you can deduct the entire cost in 2026. You don't have to depreciate it over 5 years. You can take it all this year. Now, this is a significant cash flow and tax planning tool, and most business owners are not taking full advantage of it. If you've been putting off a major equipment purchase because you weren't sure about the tax treatment, the answer is now clear. Buy it this year, place it in service this year, expense it this year. Now, related to bonus depreciation is Section 179, and the OBBBA expanded this too. Section 179 is a separate provision that allows small businesses to immediately expense the cost of qualifying property rather than depreciate it. The OBBBA increased the Section 179 deduction cap from $1 million to $2.5 million, with phase-outs beginning at $4 million of qualifying property placed in service this year. For most small businesses, this means that Section 179 cap is effectively unlimited for your purposes. So if you're buying equipment or vehicles or qualifying improvements to your business property, you have significant flexibility to write off these purchases immediately. The combination of 100% bonus depreciation and the expanded Section 179 deduction gives small businesses more first-year expensing power than at any point in recent history. So let me be specific about the actions this legislation suggests for your business right now, because knowing about it and acting on it are two different things. First, talk to your tax preparer about your QBI deduction before year end. Make sure you're claiming it correctly, make sure you understand where you fall relative to phase-out thresholds, and make sure your books are clean enough to support the calculation. The QBI deduction is calculated from your business income. That means that business income is your revenue minus your expenses, which means you do get to pay most of your expenses with pre-tax dollars. And your books need to accurately reflect your income and expenses so that the deduction can be properly calculated. Second, if you have equipment, vehicle, or technology purchases you've been considering, model the tax impact of making them this year. With 100% bonus depreciation available, the after-tax cost of the qualifying purchase is significantly lower than the sticker price. Again, that's one of the benefits of being a business owner. When you expense things like this, you're basically buying them tax-free, which is really nice. But because you're paying for these equipment with pre-tax dollars, you want to determine what the after-tax cost of your purchase is going to be. And this gives you a legitimate and legal way to reduce your 2026 tax bill while also investing in your business. Third, if you haven't reviewed your entity structure recently, this is the year to do it. The permanent QBI deduction changes the math on whether operating as a sole proprietor, LLC, partnership, S Corp, or C Corp makes sense for your specific situation. The right structure depends on your income level, your industry, and your growth trajectory, and is worth a conversation with your tax preparer to make sure you're optimized. This, by the way, is one of the things that I see the most in my own firm, is someone will set up their business as an S Corp and not realize what they've just gotten themselves into. Or they're in a very high tax bracket and they want to stay in S Corp. The structure of your business is important, and this is going to change the math on what structure your business should have. Have a conversation with your tax preparer. Let's make sure that your business structure is optimized. And fourth, and this is the one most people miss, make sure your books are current and accurate. Every single one of these deductions, QBI, bonus depreciation, Section 79, they require clean, accurate financial records to implement correctly. You cannot properly calculate your QBI deduction from books that are 3 months behind. You cannot document a bonus depreciation claim without proper asset records. The OBBBA created significant opportunities. Whether you capture them depends on whether your financial records are in the shape to support them. The One Big Beautiful Bill is not a political story. It is a tax planning story. And for small business owners who understand what's in it and act accordingly, it represents real, meaningful tax savings that are now available permanently. I have always said the tax code works for everyone. The question is, do you understand it enough, or do you have professionals around you that understand it enough to make it work for you, not just the people wealthier than you? QBI deductions here to stay. Bonus depreciation is back at 100%. Section 179 has been expanded. These are available to you right now. Whether you use them depends on two things. One is whether you know about them, and now you do, and whether your books are clean enough to support the calculations. If you want to know whether your current financial situation is set up to capture those benefits, or if you want someone to look at your books and tell you what decisions you should be making before December 31st, that is exactly what a financial clarity call is for. You can find me at mysimplebookkeeping.com. Our appointment page is mysimplebookkeeping.com/contact. My contact information is in the description. First conversation's free. After that, as time goes on, they may not be free anymore. I'm Donna Harris. This is Books and Backbound. The opportunity is there. Go get it. And if you enjoyed this, please like, share, and subscribe, and hit the red notification bell if you are on YouTube so that you are always notified when a new video comes out. Have a great day.